Hello everyone, welcome to today's US Open live webinar. It is Tuesday, January the 17th, 14:20 GMT, 10 minutes before the opening of Wall Street. This is your host, Nikos Tsabouras, Senior Market Specialist at FXCM. US markets were out yesterday on holiday, in a holiday shortened week, but one that has a heavy economic calendar, includes a heavy economic calendar, and also the continuation of the earnings season in the US, which kicked off last week. However, before we get into all of that, please read carefully through the disclaimers and the risk warnings, and then we will start. Once again, please read carefully the disclaimers and the risk warnings. Okay, let's go ahead and get started. As we look at the 4-hourly Euro USD chart, before we get into the technical outlook, let's go ahead through a few recent developments. As we said, US markets were closed yesterday, but it's a data-packed week with the earnings season continuing, and Netflix is on the spotlight later in the week. And we expect quite a few data points other than that, but we will get a bit more into it towards the end of our webinar, as usually on the what's ahead section of our session. So far, we had earlier today lackluster data points from China, whose economic growth slowed to 2.9% year over year in the fourth quarter, which brought the total 2022 GDP figure at 3%. Meanwhile, employment data from the UK also earlier today showed further increase in wages in the 3 months ended in November, and that's an important data point ahead of the CPI inflation figures, because wage inflation is an important part of it. Now, other than that, the US dollar faces some difficulties after a good weekly start, as markets continue to expect another downshift in the central bank's pace of tightening, while Wall Street is mixed as investors return from their long weekend. Now, let's get into the technical aspects. We're gonna start as usual with Euro USD. So the pair comes from a strong week, as further easing on US CPI inflation has reinforced those hopes that we talked about for a Fed pivot, while officials have not so far pushed back against those more tame market expectation and market pricing, since according to CME's Fed Watch tools, we expect a 25 basis points hike. Again, I need to remind, this is quite important, we haven't seen any pushback, despite the Fed's hawkish stance, we haven't seen any pushback against those market expectations, and we have the communication blackout period kicking off at the end of the week. So it will be interesting to see if there is an effort and a willingness to change this perception. Now, bulls are in control and now have the 1.1 handle in the right sides, although it may be early for moves towards and beyond 1.1067. However, downward pressure could be in play, but a strong catalyst will be required for a breach of the 200 period EMA around here in the 1.06 region. Now things are favorable for the pair. We talked about market expectations for a Fed pivot, while markets at the same time appear to be more convinced about the ECB's aggressive stance of the European Central Bank, and this bodes well for the pair. And also, just to remind, we had talked about that last week, that on the daily chart we have a golden cross formed, which is when a faster EMA crosses above slower EMA, and this is often considered a precursor of further gains, and that is what we're seeing so far. Now, next I want to move on to USD/JPY, because on Wednesday, tomorrow, we expect the policy decision by the Bank of Japan. Now, the BOJ is on the far dovish side of the policy spectrum, with quantitative easing, negative rates, and yield curve control. However, it surprised markets last month with a hawkish tweak, now allowing the 10-year yields to rise up to 0.5% from the lower 0.25% previously. This higher cap has already come under attack, and this widening of the range has opened the door to policy normalization. So it will be interesting now to see if more changes are in store on Wednesday. Now, given these expectations and these changes, the pair hit 8 months lows yesterday, running its third straight losing month. So that was the low yesterday, which we highlight here. Now it is exposed to the next level of support at 126.35, but we believe that a development from the BOJ or some other catalyst would be required for further weakness towards and beyond 122.62. Now, yesterday the pair managed to find support, although this changes today, and we can see a return back above 130, but the upside looks unhospitable, and we can see here how there is a strong confluence of resistances, and a disappointment by the Bank of Japan would be required for a recovery past 133.70, 134.78 region around here, which includes the exponential moving average of 200 periods. And again, we're on 4-hourly chart. Now moving on, let's go to US oil. Here it is again. We stay on a 4-hour chart. Now the commodity is upbeat today, despite the underwhelming data from China, which is the world's biggest importer of oil. Since it is held by continued optimism around China's reopening and for a less aggressive US Fed, it returns back above the critical 38.2 Fibonacci level of the November high, December low drop, and now pierces well into the daily Ichimoku cloud. You can see here today's upward movement. Now this brings 84.70 in the spotlight, although fresh impetus may be needed for bulls to take this level out and look even higher. On the other hand, one needs to be mindful that US oil had rejected these levels, the 38% Fibonacci, earlier in the month and in December. So as long as it doesn't stray away from that, there is still risk for a renewed pressure, as this would be considered as a, let's say, limited recovery, limited correction. Now, although this could spark further pressure, there are some key support levels in the broader 72.43 to 70 region, and we continue to believe that sustained weakness below these levels has a high degree of difficulty. And as the US session gets underway, let's move on to the SPX 500. As we said, it was a holiday yesterday for Wall Street. The broader index had made a strong start to the year, and we believe that it has room to catch this resistance here at 4,055, although it may be early for a bigger advance beyond the December high at 4,145. Now, current environment is favorable, counter monetary environment is favorable for the stock market, since markets expect a Fed pivot and a less aggressive hike, and so far we haven't seen any commentary that would go against this market pricing. But we still have a few days until the blackout period, and it will be interesting to see if this changes. Now, it is a bit cautious, the index is a bit cautious this week, and a move back to the EMA to the 200 period EMA around this region here, 3,900 would not be surprising, but continued weakness past this level and towards 3,763 would require a deterioration, a significant deterioration in sentiment. So that's it for the technical picture, and as usual, now let's go and take a quick look at what we expect ahead. As we said, the first one that comes up on the calendar is the Bank of Japan. Typically, these used to be non-events, but that changed last month with this hawkish policy tweak. So it will be interesting to see if more changes could come at this meeting. Again, there are many data points out this week, so we will try to narrow it down to just some of those. Now, we also expect CPI inflation figures from various regions, which include the UK and Eurozone. UK inflation had eased in November to 10.7% year over year from the previous 41-year highs, and similarly, Eurozone had also, CPI inflation had also moderated to 10.1% in November. Other than that, we also said that Fed speakers will be closely monitored, because as things stand now, we haven't seen any pushback against market expectations despite the overall hawkish stance. And of course, as we said, we have Netflix reporting on Thursday after the Wall Street close. We have already posted a separate video analysis with a preview of the Q4 earnings. You can find that on our YouTube channel and also on your respective FXCM market analysis web pages. Again, you can go there for an in-depth preview. But what we can say now is that the streaming giant comes from a very bad 2022. Although things improved in the second half, the stock posted a rebound, the firm returned to subscriber growth in Q3 after the losses of the first half, and it also launched an ad-supported tier, subscription tier, which can be very consequential, and we will be looking to more commentary or any figures around this. Now, that's it from me for today. There won't be another US Open live webinar this week, so we will return next week on Tuesday, and then to our Tuesday and Thursday typical schedule. Thank you for joining. We'll talk next week.